One reason you stay employed for a lot longer than you want, and that could be age 65, is because you need the health insurance. You have to keep working longer than you want because you get that company provided health insurance. So you wait to age 65. And what happens at age 65? That's Medicare. But then you get to retirement and you do some awesome planning with a great retirement planner and you get more income than you ever dreamed of. And then you get hit with some surcharges, some Medicare surcharges. You spent all this time contributing to Medicare. Now you got to pay premiums and you get a surcharge. Well, that's called IRMA. The income-related monthly adjustment amount is an additional surcharge applied to Medicare premiums for individuals whose income exceeds certain thresholds. It's specifically related to Part B and Part D, or D for drugs, prescription drug coverage. That predominantly covers all of your outpatient services and, like I said, the drug coverage respectively. So either way, we're just going to take this video to deep dive into IRMA, all the details, so you get all the knowledge so you can plan accordingly as you start taking your Medicare in retirement. And before we transition to the next part, please, if you haven't, hit that subscribe button. More high quality videos are coming so you can plan and prepare for retirement even better. All right, first an overview. IRMA is a mechanism that ties Medicare premiums to the beneficiary's modified adjusted gross income. If your income surpasses set thresholds, you'll be required to pay higher premiums than those who fall below those thresholds. So IRMA surcharges are tiered. More income means more surcharges. Let's backtrack a little bit. How do you even get Medicare? You essentially contribute into the Medicare system every year that you're working through your FICA or your payroll tax. You contribute 1.45% and your employer contributes 1.45%, or if you're self-employed, you contribute the entire 2.9%. So Medicare is entitled to you at some point, but that's not the whole story. Once you start getting Medicare, you got to pay monthly premiums for it. Now there's a standard base premium amount, but we got to talk about how the surcharges are determined. We'll go over the numbers in more detail in just a second. The surcharge is based off your modified adjusted gross income, and there are a few different MAGI calculations for different things out there, like the Roth IRA calculation might be a little bit different, but specifically for IRMA surcharges, they take your adjusted gross income and add back in your tax-exempt interest, if you have any, from any like municipal bonds locally in your state. The Social Security Administration then reviews your income. Now this is tricky, listen closely. They're going to review your income for 2 years prior to get you set up for this year's IRMA surcharges. So this year's 2025. They're going to look at your taxes from 2023 to find what you owe for IRMA in 2025. In 2026, it will be your 2024 taxes. So again, here's how the formula works. Adjusted gross income, add back tax-exempt interest. That's your modified adjusted gross income that is used specifically for your IRMA surcharges with Medicare. So now we're going to talk about all the specific thresholds. You can see here that they've actually done us a little bit of favor, that the bands are very wide. So let's do, in this second column here, joint tax returns. Most of the people I work with are married, but some people are divorced and or single on the first column. If that's you, go ahead and take a look as I speak here. But you file a joint tax return. If your modified adjusted gross income is under $212,000, then you have the standard premium. This is just the base premium that you got to pay to be a part of Part B or outpatient services with Medicare. That number is $185. But as you can see here, as you increase above $212,000 to $266,000, it gets a little higher. Above $266,000 to $334,000 gets a little bit higher. Above $334,000 to $400,000 gets a little bit higher. Above $400,000 to $750,000 gets a little bit higher. And then $750,000 and even higher is the maximum amount. And then if you have Part D prescription drug coverage, you can see there's even an additional premium that you got to pay to be able to have that particular coverage. And this has these specific bands as well. As you can see, there are really sharp income cliffs. Between the tiers, you can see that there could be a really, really big jump. Let me give you an example. If you have a joint tax return and you make $266,000, your premium is $259 a month. But if you make $1,000 more, your premium is going to jump to $370. That's $111 per month just by making an extra $1,000 of income. This is where annual tax planning really matters. Now, I know a lot of you are going to say, well, I'm not making $266,000 a year. Well, some of you high income, high retirement, high asset individuals, could be making that, especially in your required minimum distribution years. IRMA is applied and collected from your Social Security paycheck if you're taking it. So if you're taking Social Security, they just automatically deduct your Medicare premiums and any IRMA surcharges from your Social Security check. If you're not enrolled in Social Security, like you're delaying to 66 or 70, and you're enrolled in Medicare, you will pay those premiums on your own. They're gonna come after you for a bill. One nice thing they do is they let you appeal your IRMA surcharges. So if your income is temporarily higher due to a one-time event like selling a business or receiving a large capital gain, something really big happens in one particular year, you can apply and potentially appeal that IRMA surcharge in that one particular year. It's got to be a unique event, you know what I mean? All right, so lastly, I wanted to end here on some strategies to minimize IRMA surcharges. First is Roth conversions. The reason Roth conversions matter is because a lot of people need to use tax-deferred IRA or 401k dollars as income in retirement. And if you have those big bundles of money, you're going to have required minimum distributions. Anytime money comes out of those accounts, it's taxable. So that increases your taxable income, whether you were planning on it like a normal distribution or there was a required minimum distribution where the money movement was mandatory. You can avoid this type of money movement by planning ahead and starting to do Roth conversions, pay the taxes now and get the money in a Roth that grows tax deferred. So in the future, it reduces the mandatory distributions, or you can utilize that money for income, which reduces down your taxable income in that year. Next is tax loss harvesting. If you have some assets that have lost some value, you can offset some income up to $3,000. This is an opportunity to utilize this. Imagine if you were at that $266,000 limit and you're about to go to the next surcharge at $267,000. What if you could take a $3,000 loss through some tax loss harvesting to be able to reduce down that taxable income? And that's where some good tax planning that I do with some of my clients comes into play. You can reduce taxable income with some charitable donations if you're charitably inclined. And most importantly, the last strategy is to time your retirement a little bit better, where maybe you can reduce down your income a couple years before Medicare or those IRMA surcharges to really protect you as you lean into retirement, because before you retire, a lot of times it's your highest earning income year. So imagine if at 63 and 64, you're making $300,000, $400,000, $500,000. Your first 2 years of retirement are gonna have big surcharges when you apply for Medicare. IRMA surcharges are complex and often overlooked components of Medicare planning, especially retirement planning as a whole. Retirees with higher incomes can really get hit with these surcharges. And I really want to emphasize leading into retirement, if you're working and you're making a ton of money, have really high income the last couple of years before retirement, those years are going to be calculated into your first couple of years of surcharges when you do get Medicare. So it's really important to start planning and preparing, start thinking of your retirement strategies in a more holistic way, and identifying these small areas can really help promote a happier and more successful retirement. If you're looking for that type of planning, please contact me below. There's a link, or you can go to propathfinancial.com to learn more. Thanks for watching. We'll see you next time.